As we enter 2023, the credit card debt of the United States has soared to $986 billion, with the average credit card debt being around $6,000 for each American. This modern financial utility we know as credit cards has revolutionized the way consumers interact with the markets by extending purchasing power with the intention of paying back later, leading to greater motivation to spend, and this impulsive action is incentivized through the release of endorphins and dopamine. This reward mechanism can be exploited as we move towards a more purely cashless society facilitated by payment methods such as contactless payments. Through analyzing the credit system and conceptualizing principles of debt, it begs the question, have credit cards been a net positive or net negative for society? The truth is, it's complicated, and I urge you to really sit back and understand the menacing complexity of debt. The form of credit as you know today, such as mortgages, car loans, credit lines, weren't always this modernized, as the concept of debt has been around since the Mesopotamian times, around 5,000 years ago, and where inscriptions of recorded transactions were engraved into clay tablets from merchants to illustrate an agreement to buy something in the moment but pay back at a later time. But fast forwarding to the 19th century is a period where credit was rapidly revolutionized. New York, United States. Western Union, the established money transfer service company, was the first to issue the first concept of consumer credit cards, known as metal money, in 1914. Western Union customers were able to defer payments upon a mutual agreement from the borrower to the lender for a later period. Many years later, the notorious Charge It card was created and released by John C. Biggins of Flatbush National Bank of Brooklyn, New York. This system only functioned for any purchases within a 2-mile radius from the bank. If this requirement was met, then the purchase bill would be forwarded to the bank for reimbursement to the business. The customer would then be obligated to pay back the debt at a later time. 4 years after this, a new iteration of the credit all started with a businessman named Frank McNamara, when he was dining out with his wife at a restaurant in New York City and where he forgot his wallet. Fortunately, his wife covered the tab. This embarrassing moment was simultaneously an opportunity for the invention of the Diners Club card. It then became the first independent card company in its first year of business. Diners Club grew to 10,000 members from New York's business elite, with 28 restaurants and 2 hotels prepared to accept monthly billing. The way it would work is that 2 patrons who held the card would charge their meal to the card, and the restaurant would send the bill to the Diners Club company. Diners Club would send payments directly to the restaurant's bank and would profit by taking a small commission from the transaction, with cardholders required to pay their bill in full each month, overall revolutionizing the credit card business model. The biggest year for the credit industry was by far in the year 1958, as they started to become mainstream, and is also when one of the biggest behemoths entered the market, American Express. The once known transport company launched their first paper charge card. This would go on to be one of the first credit cards to be accepted internationally, and within the first year they issued 250,000 cards and charged a $6 annual fee. Fast forwarding and decades later, the credit card market has been metamorphosized with advancing financial technology, with large companies competing for market share every day, and leading us to the modern structure of the credit card business model. Let's break down how the credit card processing system works, although please note that this template is ambiguous due to many moving parts and alternating variables. But fundamentally speaking, there are 5 main components of this linear process. There's you, the cardholder, the merchant, the acquirer bank, the issuer bank, and the credit card network. How it would work is when you purchase a service or good from a merchant, whether online or in person, the cardholder transaction would be forwarded through the payment processor. The payment processor will then send this transaction to the acquirer bank. From here, if authorization is accepted, the acquirer would then forward the transaction details to the credit card network. The card network requests the final payment authorization from the issuing bank. Once reached here, the issuer forwards the authorization all the way back to the acquirer, where the acquirer makes a deposit into the merchant's account. Finally, the card network pays the acquirer and charges the issuer. The issuer would then post the transaction to the cardholder's account. Thus, you would receive your monthly statement and where you're obligated to make a full payment. Now, the main profit for companies is derived from you interacting with the merchants, and where the merchant pays a processing fee for every transaction, which differs for each card company. Furthermore, other ways to make money is made through interest on late payments, annual fees on certain card members, balance transfer fees, and cash advancement fees. Now that you have a rudimentary understanding of the credit card network, let us understand the downside of credit and how it creates an impediment to financial standing for many Americans. Firstly, it is important to know that the majority of the United States GDP is consumer spending at around 70%. This, of course, is the byproduct of the incredible free markets, enterprise, and entrepreneurism that brought the US to the top. But unfortunately, stars cannot shine without darkness, with the average American having 2 to 3 credit cards and the average credit card balance being around $6,000. This has led the gross credit card debt of the United States to grow to an enormous $986 billion as of February 2023. The average credit card APR is around 25%. the median bank account balance is around $5,500. There have been various studies that have made great strides to understand why this is. Let us dive into a well-known one. To understand consumer behavior, we must understand the basic psychology. A study looked at college students in the United States analyzing credit card misusage. The excess purchasing power of credit cards facilitates buying on impulse as it conceals the amount owed and delays the depletion of wealth from the user. This results into an overestimation of available buying power and incentivizes future purchases. This is being exacerbated by marketing innovations such as 24/7 retailing, the rise of e-commerce, hassle-free payment methods such as tap and contactless payment, and pay now buttons during online shopping. Extrapolating further, the main hypothesis defines impulsiveness as a predisposition to make choices favorable in the present moment rather than delaying gratification. The study shows a strong correlation with the traits of weak self-control, emotionally unstable, and materialistic among students' credit card misuse. Another interesting find among introverted students was the need for vanity, as credit cards can be seen as a sign of higher social profile, used to impress friends, strangers, and peers. But this all goes beyond just college students. Credit card debt among Americans is growing year over year, and as we evolve into a more cashless and checkless society, this reverberation can be compounded. The side effects for missing payments are distressing. With such incredible high interest rates, and because debt conceives an illusion of encouraging one to spend more than they can afford, one spends more than they are financially capable of doing so, thus costing you to pay back expensive interest on missed payments over time. This will shrink your future income, hinder your financial goals, hinder your ability to take out a fair mortgage, and any kind of borrowing due to a defective credit score. And ultimately, if all else fails due to insolvency, the last and most destructive option is bankruptcy. Thank you so much for your time. I hope that I provided value to you in an entertaining fashion. Feel free to subscribe for abnormal content about monetary and financial economics, as I am a one-man army, so the amount of videos you will see will vary from time to time, as I am very busy with my studies. With all that said, thank you so much for watching once again, and good luck out there.